On June 27, 2023, we've seen one of the various struggling EV startups, Lordstown Motors, announce a strategic restructuring process, which is really just saying they filed for Chapter 11 bankruptcy protection. Lordstown is putting its assets up for sale, which would be its first EV model, the Endurance, and other company property. This does not include the factory that they were going to use to make these EVs in Lordstown, Ohio, because they sold it to Foxconn last year, the Taiwanese manufacturing company. Lordstown is actually blaming its bankruptcy on Foxconn, saying that they were owed up to $170 million from another deal for equity with Foxconn, which would have given Foxconn a nearly 20% stake in Lordstown. But Foxconn never paid, citing that Lordstown had breached the deal because the price of Lordstown stock fell below $1. So now both of these companies will be in a legal dispute over that, but ultimately, even if Lordstown did get that money, they would still be in this situation eventually. They were just delaying the inevitable. They can blame this on Foxconn to try to use them as a scapegoat, but at the end of the day, this is a precursor of what will happen to many of these EV startups. Rivian, Mullen, Lucid, Fisker, many of these companies are starting to enter dire financial situations. Many of them went public through SPACs and have blown through hundreds of millions or even billions of dollars with little to show for it. None of them are even close to profitability, and as I mentioned in other videos, their gross margins aren't even positive. They can't even make money on the sale of their cars alone, since they need to invest in capex to scale production. Unprofitable companies on their own are not trash. I own unprofitable companies. The difference is, when you own a microcap that's losing a few $1 million a year, that can be turned around pretty quickly if they're nearing an inflection point with some solid growth ahead of them. But losing $174 million last quarter, like Lordstown was, which included a massive impairment on property, plant, and equipment, as well as sporting a solid negative 99% gross margin. You can't turn that around very fast. Scaling up manufacturing capacity and sales just to reach break even will likely take years to do, and these companies don't have years to wait. At least with some of the other EV startups, they can actually start selling cars now. Lordstown hasn't even made it to that point yet, so they're just burning through millions of dollars a day without even making anything. And this is why trying to make it in such a competitive and capital-intensive industry can be so challenging. This is not the same market that we used to be in. The era of near-zero interest rates is over. There are rising materials costs throughout the supply chain due to inflation and continued shortages. Battery metals and other materials are probably just going to get more expensive. The supply is limited and the geopolitical situation around the globe continues to worsen. And you have to ask yourself, what makes your EV startup unique? Why are they going to survive? As they burn hundreds of millions of dollars, diluting shareholders endlessly, tanking their own stock prices and relying on reverse splits just to stay listed on the NASDAQ. Why will Nikola survive? They have competitors as well in the trucking space, and they face the same issues the EV car companies have. Why will Rivian survive when others like Lordstown are not? Shareholders will only put up with this delusion for so long. People will point to Tesla and how they nearly went bankrupt several times. And I wouldn't say betting on companies losing hundreds of millions just assuming that they're somehow going to make it is the best idea. And not every company is going to be like Tesla. That company was far ahead of its time, and there was little competition in the space back then. So now all the legacy automotive companies are launching new EVs. The chance your small EV startup gets a large percentage of the market share at this point is dwindling rapidly. GM, Ford, Audi, you name it, these traditional automotive companies are entering the EV space, and they have near infinitely more resources than these new EV companies do. Rivian delivered nearly 8,000 cars in Q1, Tesla delivered 422,000. They're hardly comparable right now, and Rivian just burned through $6.7 billion in the entirety of 2022. That is a cash dumpster fire. So, to illustrate this point further, let's go through a list of all the failed traditional automakers just in the United States. What are the chances your EV company is the one that makes it? What is the massive differentiation that will make your new EV startup any different from the others? None of it matters if their truck or SUV gets a little better range than the competitors or has a slightly better pricing point if the company goes bankrupt trying to produce the damn things. How many of these companies had to fail just for us to see a GM or a Ford survive until now? Quite a few, clearly. So the entire industry is garbage, and people underestimate just how much the industry you invest in impacts a company's returns. But it's crucial to understand some of the telltale signs of a bad industry. So let's go over a list of some of the most important factors. The first being the level of competition. We've seen just from the list I showed you earlier just how red of an ocean the automotive industry can be. As consumers, we like competition to get the best prices and innovations. But as an investor, competition is the last thing you want to deal with. And this cutthroat competition ultimately leads to poor gross margins. We've already seen this start to affect Tesla. With that said, the worsening economic environment can be a part of that, but competition will have a similar effect. But Tesla's already consistently cutting prices on their cars, and Elon Musk himself has said he will have to start sacrificing profit margins, which are already around 20% to begin with, which is not very high at all. Now, capital intensity is another factor that influences gross margins. Building out manufacturing facilities is incredibly expensive. Building up the ability to build and sell a car will cost more than it does to sell a software, obviously. So that immediately brings the margins down. And 50 to 60% plus gross margins, which are actually high, are not required for good returns in the stock market, as we've seen with Walmart or Costco, for example. But the probability a business with high gross margins succeeds and returns more capital to shareholders is significantly higher. So that's a good thing to look out for. Next up is cyclicality, because clearly it's not going to be as popular of an idea to buy a new car during a recession. So this leads to cyclical financial results in these companies, and that tends to lead to worse stock performance over time. Where you can make money if you time things correctly, but true long-term investors are not in the business of market timing. Additionally, there's pricing power. At the end of the day, as more and more competitors enter the EV space, their pricing power is incredibly low. If they make their cars too expensive, then consumers will just go buy a cheaper car somewhere else. And lastly, there's the potential for a moat. What moat do most of these car companies have? What can they do that others can't? Once they reach economies of scale, that's a moat, but it's weak considering how there are plenty of car companies that have reached scale. Brand is a moat as well, and it will work in Tesla's favor, for example, but the new EV startups don't have strong brand recognition yet, so you can't rely on that. These are just some of the important factors to consider on what makes for a good industry to invest in. The automotive companies don't score well in any of these factors, and that shows in the average gross margins you see throughout the sector. It's a tough space for new companies to succeed in, and most companies entering the industry right now will probably go bankrupt. Lordstown is just the beginning. So investing in hot sectors like EVs can be enticing. There's far easier money to be made in the stock market if you're willing to put in the work. Thanks for watching.